Let me tell you exactly what is happening right now. Not a theory, not a prediction. What is actually happening in the plumbing of global markets. The VIX is at 35. If that number means nothing to you, let me make it mean something. The VIX is the market's fear gauge, but calling it a fear gauge undersells what it actually measures. The VIX is calculated from the price of S&P 500 options. It is literally the cost of insurance. When the VIX sits at 12 or 13, insurance is cheap. Nobody expects a big move. Traders are calm, complacent even. A reading of 12 means the market is pricing in roughly a 0.75% daily move in the S&P 500. Boring. Normal. When VIX hits 35, the math changes completely. The market is now pricing in a 2.2% daily move in the S&P 500 every single day. That is not volatility. That is chaos with a price tag. Options premiums explode. Hedging becomes brutally expensive. And here's the part nobody talks about. When hedging gets expensive, a lot of funds stop hedging altogether. They don't buy protection, they just hope. And hope is not a risk management strategy. So what got us here? The Strait of Hormuz. You need to understand this choke point. It is a 21-mile wide stretch of water between Iran and Oman. And through that 21-mile corridor flows approximately 21 million barrels of oil per day. That is roughly 20% of the world's total petroleum liquids. Saudi Arabia ships through it, UAE ships through it, Kuwait, Iraq, Qatar. The analysts are putting a non-trivial probability on Iran making a move to disrupt or close that strait. We are not talking about a news cycle. We are talking about a potential supply shock that the Federal Reserve has zero tools to fix. Here is why that matters so much. The Fed's primary weapon is interest rates. Rate cuts stimulate demand. They loosen credit. They make borrowing cheaper. That works when your problem is weak demand. When your problem is that 20% of global oil supply is physically blocked by a military conflict, a rate cut does absolutely nothing. You cannot cut rates your way out of a supply-side collapse. Jay Powell cannot print oil. If Hormuz gets disrupted even for 2 weeks, Brent crude does not go to $90. It goes to $120, maybe $140. That hits every input cost in the global economy simultaneously. Shipping costs, manufacturing costs, food costs, fertilizer costs, all of it spikes at the same time. That is stagflation, high inflation, and a contracting economy. The worst possible combination for central banks. The worst possible combination for your portfolio. Now let's talk about what is already breaking. The Nasdaq is down 14.3% from its February high. That is not a correction anymore. That is the beginning of a repricing. The AI trade that drove markets to absurd valuations in 2024 is getting unwound. Companies that were trading at 40, 50, 60 times forward earnings are now getting crushed as the discount rate reality sets back in. Gold hit $3,500 an ounce last week. But here's what most people missed. Why? Margin calls. This is the mechanism that destroys people in a crisis, and almost nobody explains it clearly. When a leveraged fund is sitting on losses in their equity book, their broker sends a margin call. You must deposit more capital, or we will liquidate your positions. The fund doesn't have spare cash sitting around. So what do they sell? They sell their winners. Gold was up 28% on the year. Bitcoin was up 40% from January lows. Those were the winners. Those were the positions with profit. So those get liquidated, not because the thesis is wrong, but because the losses elsewhere are forcing the exit. Forced selling is not rational. It does not care about fundamentals. It is mechanical, and it is brutal. And this brings me to something I need to say directly. Bitcoin is not a hedge here. Stop thinking about it that way. Bitcoin is a high beta risk asset. That means when risk appetite goes up, Bitcoin goes up faster than everything else. When risk appetite collapses, Bitcoin goes down harder than everything else. We saw $1.4 billion in crypto liquidations in a 48-hour window 2 weeks ago. Long positions wiped out, automated stop losses triggered, cascading sells across every major exchange. If this geopolitical situation escalates into an actual military confrontation, Bitcoin does not decouple. It does not become digital gold. It goes down with equities, with commodities, with everything. The correlation to risk assets in a genuine crisis event is close to 1. Nothing is shielded. Not Bitcoin, not tech stocks, not emerging market bonds. When institutions need liquidity fast, they sell what they can sell quickly. Crypto is liquid, so crypto gets sold. The only asset class showing genuine safe haven behavior right now is short duration US Treasuries and physical gold. And even gold got hit temporarily because of the margin call dynamic I just described. Let's talk about what a real escalation scenario looks like on a timeline. Day 1 of a Hormuz disruption. Oil gaps up 15 to 18%. Energy futures go limit up. The S&P 500 opens down 4%. VIX spikes from 35 to potentially 55 or 60. That is the range we saw during the COVID crash in March 2020 and during the 2008 financial crisis. Day 3. Margin calls hit across the entire leveraged loan market. High-yield credit spreads blow out. Companies that were barely investment grade get downgraded. Their cost of borrowing doubles overnight. Day 7. The Fed holds an emergency call. But as I said, they cannot fix a supply shock with rate cuts. Any cut they announce gets immediately offset by the inflationary pressure of $140 oil. They are boxed in. This is not a 2022 style correction where you buy the dip at a 20% drawdown and wait for the Fed to pivot. This is a fundamentally different type of shock. This is external, geopolitical, physical, and the historical playbook for this type of event is severe. The 1973 oil embargo cut S&P 500 by 48% peak to trough. It took 2 years. The 1979 Iranian Revolution sent oil up 100% and produced double-digit inflation that the Fed had to crush with rates at 20%. 20%. Think about what that does to a housing market, to corporate debt, to consumer credit. We are not there yet. But the architecture for that type of shock is sitting right in front of us. So what do you actually do? I am not here to give you financial advice, but I will tell you what the data is saying. Cash is not a bad position right now. Cash has optionality. Cash lets you buy when the real lows come in and the real capitulation happens. Raise your cash buffer. Cut leverage immediately. If you are holding anything on margin right now, this is the moment to think very carefully about whether the position is worth the risk of a forced liquidation at the worst possible price. If you are looking at your crypto portfolio thinking it will bounce back, you need to understand the environment you're in. This is not 2023. The liquidity conditions are completely different. The macro backdrop is completely different. Here is the final thing I will leave you with. History does not care about your buy the dip strategy when the liquidity is gone. In a genuine crisis, not a correction, a crisis, assets do not bounce cleanly. They grind lower. They shake out longs repeatedly. The average investor panic sells near the bottom, not near the top, and the average investor loses. You either have cash and the patience to deploy it at real lows, or you are the exit liquidity that the institutions are selling into right now. That is not dramatic. That is just how markets work.